Hey everyone. So I hope everyone is doing good today. Hope you guys are having an amazing day. So welcome to the next episode in the mentorship videos. Today we're going to be understanding PD rays, which are one of many entry model criteria. Now, what is a PD ray? A PD ray, also known as a premium and discount area, which represents an area that indicates to us when to buy or sell in the market. This allows us as traders to identify POIs, other known as points of interest, to look for directional bias or confirmation of a trade direction. We can use these PD rays for signs of entry points, show of order flow and bias, potential draw on liquidity, etc. So PD ray representing premium and discount areas. We want to use these areas for a directional bias of where the market might go to. And when we are in these areas, we can take advantage of this to use as our buy or sell entries or our short and long entries, okay? So in these areas, we're going to have POIs inside of them, which are points of interest. And in these points of interest, we can use these for our entry points, basically. And that's the overall, pretty much summary of what a PD ray will be. What is premium, discount, and equilibrium? So let's go over this one by one. So premium is an area of price leg, high to low. That means price creates a high to a low. That would be the price leg. That would be the range. Okay. So it ranges from high to low or low to high. But in a premium standpoint, if we want to use premium, we would need to have a high to a low range. Okay. So from high to low, or when price retraces back into this area of the range, we use it as an area for us to sell or short the market. Okay, so when we want to use premium, okay, we want to use premium. When price creates premium and discount, price needs to create premium and discount from a high to a low for us to be using premium. Price creates a high to a low, market retraces back up into that premium array, which will be in this model. The red square will represent premium, the green square will represent discount, okay? When price retraces back up into premium, this is where we want to short the market. Anywhere in this range, we want to short this market, okay? That's where we want to sell, okay, in premium. Discount is an area of price leg low to high, where when price retraces back into this area of the range, we use it as an area for us to buy or long the market, okay? So when we see discount, we want to buy in this area, this green area. We want to buy in this area. When price retraces, retracing means pulling back down into this range, which is going to be discount of the range. We want to buy in this area, okay? Equilibrium is midpoint or 50% of the trading range, which means when price reaches this point, price is balanced. So, if price is right now in premium, right? In this model, if price is in premium right now, for price to be balanced. So right now, when price is in premium, that means price is expensive. When price is in discount, price is inexpensive. It's cheap, right? It's at a sale. It's at a discount. That means price is cheaper. That means price is not balanced right now. It's not a balanced price. For price to be balanced, it needs to meet somewhere in the middle, which is equilibrium. Once price meets equilibrium, now price is balanced. Price is balanced and the algorithm can do what it wants with it. And price is always going to seek to reach equilibrium. Now, I'm not saying it's always going to reach equilibrium and then reject higher, just settle and consolidate at the middle, but I'm just saying that when price reaches equilibrium, that's when price is balanced. And price is always seeking for one of three things: to either take liquidity, fill liquidity, or balance liquidity. I want you guys to remember that. Price is either going to fill liquidity, take liquidity, or balance liquidity. Remember these. So, in these areas, we use this as indication for when to buy and sell, or when price is balanced, or other known imbalanced. So when price is in premium, it's imbalanced. When price is in discount, it's imbalanced. But when price reaches equilibrium of the range, the midpoint of the range, this is balanced price. Okay? So I want you guys to think about it like this. So if you're gonna go buy milk at a store, okay? If you're gonna go buy milk at, I don't know, Walmart, right? You go into Walmart and you try to buy milk. What do you want to buy milk at? A discount, right? You don't want to spend that much money on milk, you know? They got a 25% discount going on. You want to buy that milk because it's at a discount, right? When you are an owner of a store and you're trying to sell milk, how do you want to sell milk? At a premium, right? You want to make a bigger profit off of the milk that you're selling. So you don't want to sell at a discount. You're not making that much money. In return, you're actually losing money. But actually, in premium, you're going to be making more money. Okay? So if $2 is equilibrium, that's the standard price for milk. If you're going to sell it at premium, you're going to be selling it at like $3, $4. You're making an extra $1 or $2 per milk that you sell. You sell at discount at a discount, you're selling for 50% off, you're selling it at $1. That means you're losing $1 in profit, right? So whenever you think about it like that, just think about that analogy comparing it to selling and buying milk. When you sell milk, you want to sell in premium, just like the market. You want to sell in premium. When you buy milk, you want to buy at discount, right? You don't want to buy in premium. You don't want to sell in discount. You always want to sell in premium, buy in discount. So think about that analogy, okay? So in these areas, we use this as indication for when to buy and sell when price is balanced or imbalanced, okay? So when price is imbalanced in the premium, we want to sell in this area. When price is balanced in equilibrium, now we can see or anticipate what the market is going to do. Is it going to go into the premium area or is it going to go into the discount area? Which way will it go? Because price is balanced, but it needs to go into one of these directions because those are the only two directions it can go. It can go sideways and consolidate for a bit, but it has to go on either side, one or the other, right? So we can use premium and discount to tell when to buy and when to sell. Remember, buying in discount, selling in premium. Equilibrium is balanced price. What types of PD arrays are there? There are many types of PD arrays that you need to learn and to know, but the main and also basic ones that you should focus on are going to be order blocks, breaker blocks, mitigation blocks, rejection blocks, propulsion blocks. And then now, we also have imbalances, other known as inefficiencies or fair value gaps, which are going to be the basic introduction to advanced gap theory, which we will go over in another video. These are going to be the introductions to advanced gap theory, okay? Which are going to cover buy-side imbalance, sell-side inefficiency, other known as a BISI, sell-side imbalance, buy-side inefficiency, other known as a SIBI, and IFVGs, which are other known as inverse fair value gaps. Order blocks. So a bullish order block is the last and or few down close candles before an impulsive move to the upside. A bearish order block is the last and or few up closed candles before an impulsive move to the downside. Order blocks will have displacement majority of the time, and mean threshold is midpoint or 50% of the order block, which should be respected. So let's dissect this as well. We're going to dissect this, okay? So let's go over the bullish order block, okay? So let's look at the bullish order block right here. The bottom model right here. So this bullish order block. So a bullish order block is the last and or few down close candles before an impulsive move to the upside. So bullish, meaning it wants to go up, right? It wants to go up. So you see how the market trades down, creates this last down close candle right here. So in this, the white candle is the up close, the gray candles are the down close. This gray candle is the last down close candle, right? Before an impulsive move to the upside. Market impulses up, having displacement, okay? So this last down close candle before an impulsive move to the upside that is our order block. That is our order block. So when the market trades back down into this order block, right, this bullish order block, we want to buy the market here. This is where we want to buy the market. And talking about premium and discount, if this is in discount, we want to buy the market in discount, which will be in discount, right? Now, when we talk about mean threshold is midpoint of this candle. Middle of this candle is mean threshold. What we want is the market to respect mean threshold, and what I mean by respecting it is we don't want the market to trade and close down below the mean threshold. Now, the market can wick past this mean threshold as much as it wants to, but what it's not going to do, and this is what we don't want it to do, we do not want it to trade and close below mean threshold, which is 50% of the order block, okay? Now, a bearish order block is the last and or few up close candles before an impulsive move to the downside. So bearish, meaning it wants to go down, right? So it's the last or few up closed candles. So right here we have our last up closed candle before an impulsive move to the downside, having displacement over this low. Remember, displacement, body closing over the low. Same thing here, body closing over the high. That's displacement to the downside right here on this bearish order block. What we want is the market to trade back up into this candle and then reject lower. So we can use this as an entry point for us to short the market. And if it's in premium, that's another confluence for us to enter for a short here. So again, a bearish order block is the last and or few up close candles before an impulsive move to the downside. So we want to enter on this order block, and we want it to respect the mean threshold, meaning we do not want the body to close above it. Now, the wick can go as far as it wants to. The wick can go as far as it wants to, but this order block, we do not want to see a body close above this mean threshold. Once it does that, that is a sign of disrespect. That means this order block is invalid. Okay? Order blocks will have displacement majority of the time. So again, displacement, having displacement over this low, having displacement over this low, having displacement over this high, displacement over this high. Remember, body closing over the low or body closing over the high. That is displacement. And displacement, that is a sign to us that smart money is involved, okay? So smart money, okay? And we will get into that into another video, okay? Of what smart money is and how smart money works, okay? Mean threshold is midpoint, 50% of the order block, which should be respected. So again, we do not want to see the market trade above this and close above this. We do not want to see the market trade below this and close below this, okay? We do not want to see either of those, and we want it to respect that, okay? We don't want to see any of that sort. We want to see that respect, okay? So order blocks. Let's move on to breaker blocks now, okay? So a bullish breaker block is when a bearish order block gets disrespected, which shows weakness in bearish order flow, which then can be used as support to push for higher prices. And the order of it would go low, high, lower low, higher high. A bearish breaker block is when a bullish order block gets disrespected, which shows weakness in bullish order flow, which then can be used as resistance to push for lower prices. And this order would go high, low, higher high, lower low. Okay? So let's separate the two and let's go over a bullish breaker block first. Okay? So a bullish breaker block is when a bearish order block. Let's stop there. Let's look at this. This is our bearish order block right here. Market trades back down, has displacement over this low. But then the market trades back up, disrespects this order block. Remember, what do we get when we get disrespect? We get a close over mean threshold. We have a body close, and then we get displacement. This is disrespecting this bearish order block here. So what does it turn to? A bullish order block. Okay? So when we think about support and resistance, what did I say? Retail traders believe that when the market trades up to highs, it's going to reject highs. When the market trades up to lows or down to lows, it's going to reject lows, right? But here we see that the market pushed past this high, took out the high. So whoever was shorting there would have got stopped out here, right? And whoever's going to long, right? Whoever was longing right here would have got the advantage here. So retail traders would have stopped out, but the people who went long would have made profit here. Okay? But what I'm getting at here is when I say support and resistance, I'm not talking about traditional support and resistance. I'm talking about real institutional order flow for support and resistance. And how do institutions use support and resistance? So when we talk about smart money, right? Let's just go over this right now, and then we'll go over it in specified detail later on. Okay? So when we talk about smart money, right? Smart money represents the big institutions, the banks, the people with the fuck you money, okay? The people with the money that you can fucking throw at them and they'll go from fucking poor to rich in fucking 2.5 seconds. That's the kind of fucking people I'm talking about. Smart money, when they have displacement over highs, that means smart money is involved with this trade. When you got displacement, that means smart money is involved with this trade, okay? When we look at this trade, do we have displacement over a high? Yes. Yes, we do. So, when that happens, this order block gets disrespected. And order blocks are specified to have holding what smart money call as entries. Now, when we disrespect the order block, that means we aren't entering on that side of the market. We aren't entering on the other side of the market. So, with that case, if we have a bearish order block, expecting to have bearish order flow coming into the day, boom, we disrespect it to the upside. This order block is no longer valid. But what it does turn into, it turns into a breaker block, which would be going from a bearish order flow order block to a bullish order flow order block, which would be known as a bullish breaker. And when that happens, when the market taps back into this order block, other known as a breaker now, it's going to reject higher, other known as supporting price. You're supporting it at the bottom here to go higher. Now, this is not traditional support and resistance. If anyone brought up to me, oh, does support and resistance work? No, it fucking doesn't. It's fucking bullshit. This is real support and resistance. This is real support and resistance. The market disrespecting an order block, turning into a breaker, and using it as support. Now, a lot of retail traders will see this as, oh, it's resistance turning into support. No, it's not. It's an order block turning into a breaker block. It's smart money getting disrespected, and then another smart money getting respected and pushing through that other smart money. Okay? So this is how institutions work. Not support and resistance, but using actual support and resistance by market sentiment. Market sentiment being the market's perspective, not people's perspective. Now, let's move over to the bearish breaker block. A bearish breaker block is when a bullish order block. Let's stop there now. Okay? Bullish order block. Last down close candle before an impulsive move to the upside. Last down close candle, impulse move to the upside. Closing above this high right here. Market trades back down, having displacement over this low. Disrespect this bullish order block. Bullish order block gets disrespected. Bullish order block gets disrespected. What does it turn to? A bearish breaker. Now we have bullish order flow here. Disrespect bullish order flow. Now we have bearish order flow. Once the market trades back up into this order block right here, right? Once it trades back up into this order block, we want it to reject lower, another known as resistance, okay? So this would be known as resistance right here. Not regular support or resistance, just resistance in the sense of price resisting to go higher and then pushing down lower, okay? Now, I know I said we want market to respect mean threshold, which is 50% of the order block. That's ideal. That's ideal, okay? The market can go as far as it wants with the wicks, okay? But we want to ideally respect mean threshold. We don't have to, but the more we close past mean threshold, the more we have the likelihood of disrespecting it, okay? But if it does close inside the range of the order block, it is still valid, okay? So a bearish order block, a bearish breaker, is a bullish order block that gets disrespected to the downside, then turns into a bearish breaker, which will act as resistance to resist price from going higher to reject lower, okay? Now, let's go over mitigation blocks. A bullish mitigation block is very similar to a bullish breaker, except there's no liquidation to the sell side. And this order would go from low, high, higher low, higher high. A bearish mitigation block is very similar to a bearish breaker block, except there is no liquidation to the buy side. High, low, lower high, lower low. Okay? So let's go over this bullish mitigation block. So, if we look at this mitigation block, it goes in the same sense of a breaker block, right? It's a bearish order block, move to the downside, gets disrespected to the upside, comes back down, acts as support to push higher. Only difference is, this is the second high. It's the higher high, okay? Or the higher low, sorry. This is the second low inside the range. This is the second low inside the range. With the breaker block, this would be that breaker. This would be the breaker. This wouldn't be the breaker, right here, right? Okay, so the breaker would be probably the first high or low in the range, okay? The first high or low in the range would be the breaker, okay? The first high or low in the range would be the breaker. In a mitigation block, it's the second high or low here, okay? Second high or low here. So if we have a bullish mitigation block, okay, that means we're looking for a bearish order block. Boom, bearish order block. Somewhere right here. It would be somewhere right here or somewhere right here. So let's just go with this. This would be our bearish order block right here. But because it's not the last down close candle or last up close candle before an impulsive move down, that wouldn't be our bearish order block. This would, because it's our last up close candle before an impulsive move down. Do we get an impulsive move down? No, we just get one candle. Do we get an impulsive move down here? Yes, we get a little drop down here. So this would be our bearish order block. Market disrespects it to the upside, turns into a mitigation block. Market trades back down, acts as what? Support to push price higher. Okay, so a mitigation block is the same thing as a breaker block, except there's no liquidation at the bottom. No liquidity sweep, and it's the second high or low of the range. Okay. Bearish mitigation block is the same thing. We need to find a bullish order block. Okay. This would be our bullish order block, but we don't have an impulsive move to the upside. Okay. No impulsive move to the upside. So because of that, this would be our bullish order block. Impulsive move to the upside, trades back down, disrespects it. Market trades back up. Market uses this as what? Resistance, right? Resisting price to push higher, pushing price lower. Okay. So mitigation blocks, same. It's basically the same thing as a breaker block, except there's no liquidation to the buy side or the sell side. Okay. Now the final or second to the final order block is going to be a rejection block. Now I suggest you guys don't pay attention to these. These are a little bit more advanced and they are rare to spot. But when you do spot them, you can mark them out. But I recommend that you don't use these as much. Now, in the 2023 model, these will be translated into a thing called Mohawk wicks. Okay, and we will go over that, which is part of advanced gap theory. Okay, but right now, I suggest that you guys pay attention to this, but don't prioritize this. Okay. So rejection blocks are when price runs the body of the candle and takes buy side liquidity or sell side liquidity. I recommend staying away from these because they are not going to be as reliable and harder to spot for new traders. Okay, so you see how the body closes, or the body closes here, but then opens down here. Body closes here, opens down here. Okay, body closes here, opens here. Body closes here, opens down here. So it's when the bodies close at like a distance from each other, and that's when price rejects the wick usually. Okay, now the final order block that we're going to go over, these are called propulsion blocks, and I want you guys to pay close attention to these. Okay, so a bullish propulsion block or bullish propulsion blocks are a candle or a bar that has previously traded down into a down candle, otherwise known as a bullish order block, and takes over the role of price support for a higher price movement. It's basically a bullish order block that tapped into a previous bullish order block. So you see, this is our order block. Market trades back down into this order block. This is our propulsion block right here. Now our propulsion block, once we trade up above it, trade back down into it, we want to enter on this propulsion block. Okay. So when you talk about fractal, so price is very fractal, which means things reoccur. So write this down in your guys' notebook. Price is fractal. Fractal means reoccurring things. Things reoccur in price, which means things reoccur in happening in price, and things just reoccur in price, period. Okay? So when things reoccur in price, that means things are going to happen over and over again. Okay? So when we look at PD rays happen over and over again. Okay? So when I talk about a fractal entry, whenever we're going to trade live or whenever we're trading period and I say price is fractal and I see a fractal entry, that means I see a reoccurring entry. Propulsion blocks are one of those reoccurring entries. Okay? So when say you have this order block here, market trades down, enters this order block, this would be the main entry. This propulsion block would be our second entry, our secondary entry, or they're known as a fractal entry. We can use this as a forgiving entry for us to enter again if we missed this entry. Okay? Same thing with a bearish propulsion block, are a candle or a bar that has previously traded up into an up candle or bearish order block and takes over the role of price resistance for higher price movement. It's basically a bearish order block that tapped into a previous bearish order block. So whatever you see here, just think about it in the opposite sense. Okay? So again, propulsion blocks are used as a fractal entry, a secondary entry, or a forgiving entry. Those are all pretty much the same names for me. Okay? Forgiving entry, secondary entry, or fractal entry. That's what propulsion blocks are meant for. And using propulsion blocks to see if it respects it or not can show us what type of order flow we're in. Remember, order flow, what direction the market is favoring. Okay? Now, let's move over to imbalances, inefficiencies, and fair value gaps. Okay? So let's go over the first one. A BISI, other known as a buy-side imbalance, sell-side inefficiency, is a 3-candle pattern when the first candle's wick high doesn't touch the third candle's wick low. Okay, let's go over this. So a BISI, right? This is a BISI here. So it's a 3-candle pattern. So 1, 2, 3, 3 candles in a row going up, going bullish, right? It's a bullish 3-candle pattern. And this is when the first candle's wick high, so the first candle's wick high doesn't touch the third candle's wick low. The third candle's wick low. This is when they don't touch. You see how they're not touching. And this is creating a gap here. This is creating an imbalance in price here. This is creating an inefficiency in price, right? So this gap here is known as a BISI, right? And other known as a fair value gap. This is known as a BISI fair value gap, okay? You can use BISI, you can use the term fair value gap, other known as an FVG, or a bullish gap, okay? So this BISI, other known as a buy-side imbalance, sell-side inefficiency, is a price point or a PD array or a POI, okay? So this is a PD array that we can use for us to buy price, okay? It's a BISI, buy-side imbalance, sell-side inefficiency. This is where we want to buy price, okay? Buy side was offered, but sell side wasn't present, causing an inefficiency. So because buy side wasn't offered, that means it's imbalanced on the buy side. Sell side wasn't present, causing an inefficiency on the sell side, which price is inefficient on sell side. So it's a buy side imbalance, sell side inefficiency. So when price comes back down into it, that means when price fills here, fills this gap, and then trades back up, that means price is balanced here once it taps into it. That means price is efficient when it taps back into here. So BISIs are PD arrays that we want to use for us to buy price. Okay. CE, other known as consequent encroachment, is midpoint or 50% of the fair value gap, which we want to respect. So, like mean threshold, 50% on the order block, consequent encroachment, which is 50% of the BISI or fair value gap, is where we want to respect. Remember, the market can trade down into consequent encroachment, but we don't want it to close past the fair value gap, and we do not want to see it close past consequent encroachment. Once it starts to do that, that's when we start disrespecting the BISI. Okay? Now, a SIBI, other known as sell-side imbalance, buy-side inefficiency, is a 3-candle pattern when the first candle's wick low doesn't touch the third candle's wick high. Okay, so a SIBI down here, the first candle's wick low doesn't touch the third candle's wick high, causing a gap, right? Causing an imbalance or inefficiency in price here. This is also known as a fair value gap. So anytime you have these gaps, they are called fair value gaps. So gaps of fair value. Fair value means, and make sure you guys write this down, fair value means price not being inside or in this space or area for a long enough time. So that means price hasn't been in this area for a long enough time. So because this is a fair value gap, this is a gap of price not being in here for long enough, right? Because price didn't get to have this first candle's wick touch this third candle's wick. So because of that, price wasn't in this area for long enough for price to become what? Balanced, right? So sell side was offered, but buy side wasn't present, causing inefficiency. So there's a imbalance on the sell side, right? And we were inefficient on the buy side. So because of that, right, we want to sell this SIBI. So when the market comes back up into the SIBI, we want to sell the market. Once the market comes back up into the SIBI, what happens? Price becomes what? Balanced, right? Price becomes balanced. Price becomes efficient, okay? So again, we want to buy when market trades down into the SIBI. We want to sell when market trades up into the SIBI. Sorry. Okay, let's say that again. We want to buy when the market trades down into the BISI so it can reject higher. We want to sell when the market trades up into the SIBI to reject lower. Okay? And finally, we have imbalances, inefficiencies, fair value gaps. The final part of this will be an inverse fair value gap, other known as an IFVG. Inverse fair value gaps are failed or disrespected fair value gaps, which act as support and resistance. A disrespected SIBI acts as support. A disrespected BISI acts as resistance. So what I mean by a disrespected SIBI acts as support, when the market disrespects a SIBI, you are going to turn that SIBI into a BISI, basically. When the market disrespects a BISI, you turn that BISI into a SIBI, basically. So if you're going to sell the SIBI, if the market disrespects the SIBI, then you would buy the SIBI. If you buy a BISI and the market disrespects the BISI, you want to sell the BISI. Okay, so let's look at this model. Right here we have a SIBI, a sell side imbalance, buy side inefficiency right here. Market disrespected to the upside, closes above the gap. This SIBI gets disrespected. We can use this SIBI as an inverse fair value gap now. Now instead of selling this SIBI, what would we do now? We would buy it now. Use it as an inverse fair value gap. So the market creates the SIBI, disrespects it to the upside. Now we use it as price to support price to go higher. Same thing for a BISI. We want to see it act as resistance to resist price from going higher. Okay, so again, an IFVG is a disrespected fair value gap that we can use as support and resistance. Okay, I hope you guys had wrote down everything that I had shown you guys here. I hope you guys can look back through this video if you don't understand anything. And if you guys have any questions, just either DM me or type into the chat of the Discord, or even just put in a ticket to let me know if you guys have any questions. Okay. Other than that, I hope you guys have a good rest of your guys' day, and I will talk to you guys in the next video.